Hello and welcome everyone to the weekly Delphian meeting. Thank you for attending. So today what we're going to do, we're going to go through the market update. I'm going to talk through, we've been doing a lot of research on the bull put for the studies. So I think we've come up with the solution. So I'm going to show you guys exactly what we're looking at doing and take your thoughts on that. Also, we'll go through with Shawn, go through his normal kind of earnings stuff, and obviously we'll go through and answer questions if you got them. So let's get started. Okay, for market update, so you just look at the big board here, nothing changed. Russell still in 2, everything else held in 1. We've seen, the state ones climbing up, I think it was down in the low 20s. So now we're back up at 40, getting kind of in the neighborhood of overbought, but not quite there. The pies definitely increased for the green side. We were down to, I think, 23% a couple weeks ago, and it's just been pretty much a beeline up to where we are currently. So obviously it's been a pretty good little run there. So let's take a look at the market pulse. So, this is what I was talking about. We were down to 25% in state ones, and since then, July 20th, it's been pretty much straight line up. There we got some more people joining. It's been pretty much straight line up from there, although the state 8s are holding, slightly kind of increasing. So those have been on pretty much an uptrend since the end of June here. We were down in the 9s, so now we're up at 19. So it's been a nice little bullish run here past couple weeks. Nothing else really to talk about there. We'll look at the bullish bearish also. As far as the new lows, we had little bits of spikes, but nothing sustained. It seems like it's getting a little more active, not like a base flat line like this, but it seems like it's getting a little kind of more active like it was here. So always just keep an eye on that. Look for sustained movements up in those new lows. But still, we're down pretty low. I wouldn't say exactly flat line, but not much of a pulse. So just a little bit. So nothing too concerning about that right now. So overall, if we look at bullish bearish, I know some people look at this. I kind of check this like once a week type thing, whereas I look at the other one every day. You can see here just like the number. So from that July 20th, 19th, we were, let's go to the percentages, sorry. We're down in, I guess, upper 20s there, and it's just been straight, it's been a straight line. So we're getting close to, the crossover point. So that'd definitely be something to look for, in the next few days, kind of see, okay, is it going to pop up or is it going to, turn back there? So that, that should be within the next few days here. Okay, so let's move into state modeling. SPX, well off the chart and chugging along. It's been definitely very strong overall, throughout the whole move. So, really, it's not even really in the range of target 3 anymore, so we can't really use that. But what we do use has been highly effective is the 50-day SMA on SPX, and that is really the biggest, most important thing that I would be watching on a kind of daily basis here. So tested it over and over again. I don't think I have to keep harping on that. Something broke. So this is obviously the biggest thing that we want to watch is the 50-day SMA. So, it's well above there, and it does like to, pop back, have these little moves down, hit it, and then bounce off. So, I think that would be something we'd expect in a, little near future. Obviously, keep watching this 50-day SMA. The most important thing, we've been harping on this for, I don't even know how long, a long time. So, just keep your eye on that one. And I don't think we've been, at least since like the beginning of the year, we've been talking about this. So, okay, anyway, so that's the SPX. Let's talk about the NDX. So that one really popped up and pretty much has run out of steam. It's above still in state one, above target 3. Just kind of going sideways for a little while here. Then kind of ran out of steam, but really took off. Had some problems with that target 3, popped up above, and now it's just like floating along here. So obviously that target 3, that would be key support. See if it can stay above there. We're a little bit off it. Right. Yeah, we're a little ways from there. So 300 points. But that's really the only thing we can pull from here. But it does look like it's kind of ran out of juice, at least for the NASDAQ. S&P just keeps chugging. Russell, we've been sideways since February or something. And we talked about to kind of expect this to be sideways in state 2. So that has occurred. We're just kind of flopping along here. This thing's been sideways. Shook talked a lot about this, but it's been 6 months. We've pretty much done nothing with this. So, I'd just say for this one, we kind of want to watch the highs and lows. So down here, we have the current state high and low. See if it can, close above or below there. That, hopefully give us some indications on where the market's going overall. This 2,000 stocks, a lot of, not a big market cap, of the market, but a lot of numbers of stocks. So, so I'd kind of see if we're going to stay in this range or if we can break out either up or down, kind of just floating right in the middle. So nothing else really from there. And I think that was it. The quick tour of the market. I'll open up to questions or comments on that.
Well, there's a lot of chatter in the news about everything being on hold for this Jackson Hole meeting at the end of the month.
Yeah.
So, and but as long as the pie is growing, the green pie on the
This one.
the green pie, I notice a lot more trades work when that green pie is growing than when it's shrinking.
Right. Yeah, I agree with that. Especially if you're doing like calls or stuff like that. The spreads, depending on how they're structured, I think they can profit in sideways and up markets. But long calls you definitely need an up market for those. So yeah, we're going to do some more analysis on everything involved, with the market pulse and stuff as we get time. So.
And I found that green pie, and you showed it also in the graphs where you were showing the bullish and bearish. It's similar, just one's a line and one's a pie chart. Yeah. But that is a better indication of the mood of the market than the major indexes, because the major indexes are so controlled by the big market cap stocks,
Mhm.
you know, they can go up. They were going up when that green pie was going down.
Right.
And but the green pie is a better indication of the overall broader market, and then an indication if people are buying into the broader market, you
Mhm.
know, the mood of the investor is generally positive, or at least calmer, right?
Yeah.
So
More broad, based indicator than just looking at SPX or, Russell, I think is a good one also, encompasses a lot of stocks, but yeah, this obviously takes into account like 4,000 or something, including ETFs and stuff like that. But yeah,
right,
for this also, I mean, you can go back and, go back in time and, that this kind of level, in the 20s, historically, if you go back, it's, outside of the pandemic type stuff, like normal scenarios, you get down around there, it seems to be want to bounce, that's the 25 line. So, this was obviously taper tantrum, outside of these kind of crazy events that, this kind of level, around 30 or something seems to be like a good, inflection point for things to, turn back up. But, I was doing a little analysis on it, but, I'm trying to build it into a signal so we can, test it methodically instead of, the eyeball test. But, you guys can obviously do this kind of stuff too. So.
yeah. Yeah.
Yeah, so I think, Jackson Hole, obviously the Fed's gonna, control a lot of the direction. So always, always listen to what they're saying. So I'm not sure if there's gonna, obviously there's inflation out there. I'm not sure when they're gonna actually acknowledge it other than it being transitory. If it's persistent, at some point they're gonna have to shift over their stance, but we'll see. I don't have a crystal ball on that one, so.
Yeah, well, nobody does. That's why. But I hear there's a lot of put activity out into September, you know, hedging against the Jackson Hole meeting. So,
Mhm. Yeah, well, that makes sense. So, thanks, Sadir.
mhm.
Anyone else? All right, well, we'll keep on moving here. So, what I want to pull up, so, people that follow the studies, I'm not very happy with the bull put that we have. Sometimes those trades will come out, and Sadir, I'm sure you've seen it, where it's like, okay, I'm risking $50. And I mean, my reward is, my max profit's like 50 or 100, and I'm risking 950 or 900, like not very good risk reward. So, and sometimes it's hard to execute those, especially the, two strikes below the, that buy put can be difficult too, especially, getting out or, so we looked at, changing that, going forward. So what I'm going to show is basically I'm trying to mirror this bull call mostly, but with a bull put, because this bull call works really well. So, I just took a couple state one transitions a few days back, and, I'm tracking other things too, but I'm trying to compare these different strategies, and I'll explain exactly how I set it up. But, basically I tried to match the max risk, and then, the profits going to be right here, the max profit. So this is your new bull put, and that's the old bull call. So, you're risking, your max profit's going to be a little less on this bull put, but your break even is actually lower than what you got for the bull call. So I'll show you how I set these up, and then I'm going to show you some of the testing, and then I'll get your feedback on what you guys think about this. So basically, so we had this, the close price there of 67. So you're selling, the put right below the first one available below the current close. So that's at 65 there. And then you're buying right above the lower standard deviation. So you can see the setup here, the sell 65, and then you're buying the 60. So, I'm not sure if we had to break even on this. We should put, Sean, write that down. We need to break even on these. So when I actually created it, it showed me the break even, but it's not showing here. So I think we need that here. So, I'm not going to do the math in my head, but so this break even would be, a little, it's going to be lower than what we had for this bull call. So the bull call, just to kind of show you, and we're looking for 25% on this bull put now, because we're getting a lot better risk to reward. So, we're getting at least 30% of the width. And, typically, sometimes it'll be a little lower, but, sometimes it's over 40%. So what we had with the bull call, we're buying this deep in the money, and then we're selling, one strike above the current close. So, overall, it's very similar. We could make it match exactly almost, by selling one, this put, we could move it one strike above, and then it would pretty much mirror this. But, I like a lower break even and than what we had before. So, and your max profit's a little less, but overall, I think this is going to be a lot better. And one of the main drivers is this, we're trying to do this bull call, and I really love this bull call trade, but that deep in the money can be a real problem executing that, not for like SPY, but for like LNC, TSM, we can get really wide spreads. Especially if the thing starts moving up. Now there's no activity down there. Whereas, these bull puts will be a lot easier to execute, with those trades. There should be a lot more activity, one strike below, that's your main driver for your profit. And then, we're still have that one strike above the standard deviation. So this one might be a little tougher, but this one will be real easy to execute, which is, driving your profit anyway. So,
Hey, Josh.
yeah.
It's Bob.
Hey, Bob.
Hey, I've watched several webinars recently and a while ago
Mhm.
that have convinced me that the spread is more important than liquidity.
Mhm.
I realize that doesn't sound terribly profound. What I'm leading to is, if there's some agreement on that point, could we not come up with a figure of merit for spread? I think a Shook's favorite is ask minus bid divided by price.
Mhm.
I'm not sure that's the right one, but there is a right one, and you guys can probably figure it out better than I am. What I'm looking for with this question is, do we agree that there's a figure of merit for spread that would be helpful to us in our trading decisions?
I definitely think there is, and I think that's future projects, because we had discussed, we put out for like studies, there's 4 different trades, like, well, which one's the best, and that's what we have to figure out, right? Whether it's a bull call or, just between the spreads, which one's better. But yeah, we have discussed, at least in theory, a little bit of that and trying to figure it out. But we haven't, dove into that as of yet. But yeah, I agree. There's there should be like a ranking, that we could come up with, when a trade comes out, and okay, you're only getting 25%, reward for this one. Here's the bid ask divided by the price, and you can come up basically with a, figure of merit, 0 to 10 or 0 to 100 or something like that, right? As a like base case, obviously we could get a lot more technical, but that'd be, I think, generally kind of what you're looking at.
I'd take anything.
Yeah, no, it's a good point. It's definitely on our radar, not our close-in radar, but our long-distance radar.
Thank you.
On the bull puts, if I can't get $1 for every $5 in width, I don't trade them.
Okay.
I will, you have the recommendations, let's say on a Keltner deep pullback or 1-year SPX correlation
Right.
or whatever, right? And maybe when the recommendation comes out, just assuming it's a 5 wide and it's sitting there at 80 cents,
Right.
I'll do a good to cancel order for $1 limit.
Right.
And I'll leave it out there for a couple of days, maybe a week.
Mhm.
And either it executes or not.
Right.
But my figure of merit is I want $1 of credit for every $5 of width. So if it's a $10 recommended spread, then I want $2, right?
Right. So you want 20%. That's
Exactly. Now in this works in the case where you've got the Keltner pullback, the 1-year SPX, because the stock has dropped, increasing premium of the puts, right?
Mhm.
Now, it doesn't work if you're on a breakout or
Right.
a transition to 1, because stock has risen, decreasing the premium on the puts,
Mhm.
right? So anyway, for what it's worth, that's what when I get a recommendation from Delphian, I put good to cancel, $1 limit for
Right.
every 5,
Right.
and I think I about 70% execute and 30% just end up canceling, but that's okay. If I didn't get my $1, then I'm not in the trade.
Right. Yeah, then it's not worth risk reward, right?
Yeah, it doesn't fit my personal risk reward or figure of merit, as Bob was saying. So
Mhm. Okay. Okay. Well, I'll show you. So I did some study analysis. It's an eye chart here. So basically, I summed up, this is all this testing. It was a lot of fun. So I did every single one.
this looks like fun, Josh. This looks like a lot of work.
This is my fun. I'm the weeds guy. I go in the weeds. So this is 2018 to beginning. So January 18 to January 21. So this is all the bull calls for all the studies, not counting. This doesn't factor out the high probabilities. This is just everything that triggered. So basically, those bull calls were like 88%. You're risking 1,300 per trade, and that's your profit. A ton of trades, so 5,000 about. So the old bull put basically, had an 80%. You're risking about half of the bull call, but you're in there for a long time, 26. Because we're looking for 80%, and it's maybe like Sudhir, you're getting $1 for every 5 with. So obviously, I think this is the new one. So we're only looking for 25%, and basically it had a better win rate. Days, it's risking less than the bull call, and but you can see the win rate's a little better because your break even is going to be lower than what your bull call is, but your profit's a little less too. So really, I mean, it's just trade-offs between risk reward. I did put in like a minimum reward of 40. So if it's 10 wide, you got to get at least $4. So you're getting better risk reward on these. And also you're getting, it'd be a lot easier to execute these trades with the out of the money puts. So
I lost you a little bit on the new bull, on the old bull put.
Yeah.
Your target order was at 80% of the credit.
Right.
You're saying now you're changing the target order to 25% of the credit?
Yeah. But you're obviously getting a lot better reward than what you were down, because that old bull put, you were selling one above the lower standard deviation, and then you're buying 2 strikes below that. So
right.
yeah. So now, this is pretty much pretty close to a mirror of the bull call, but on the put side.
So when you get 25% of the credit, you're out. And so will these be replacing? This will be in the study, the Keltner deep pullback and all that. Those
that's what we're discussing, and
okay.
everyone seems on board with it. Shook, Joe, Shawn. So I think it's going to show you guys so you can get your thoughts on it too. But,
Hey, Josh.
yeah.
I think there's only two columns here that really make much of a difference for a short-term trader. That's win percentage and ROR per day. Look at the win percentage for row 4, bull put old.
Yeah.
Look at the ROR. The other 3 RORs are 9 to 10 times better than row 4.
Right. Yeah.
The reason I'm pushing this is because I think in these presentations, win percentage and ROR per day deserve a great deal of emphasis. And I think it's particular to being short-term traders, which almost by definition, if we're listening to this webinar, we're short-term traders.
Right. Short to swing trader type, I guess would be the other, up to a few weeks or something, Yeah. I agree. I think the other part is just the average days too. I think is something important to look at. I mean,
I don't think so, Josh. The average days is considered in ROR per day.
Oh yeah, you're right. It's a good point. Per day. Yeah, you're right. You're right. So
I like it.
right.
I like bull puts. Those are the majority of my trades.
Yeah.
But I always found that going 60 days out and putting it at the lower standard deviation a bit long for me. I was modifying the recommendations to be a 30. I would always go to the studies tab and look at how that would do over 30 days.
Yeah.
So, I was always modifying the recommendations anyway, and this essentially back tests and modifies it a little bit more, even though it's a 60-day bull put.
Right.
If it's getting out quicker than the old bull put,
right.
it effectively does what I'm doing manually anyway.
Right. Yeah, and I did some secondary testing. I changed I tried to get 50% and 25 was better. I did that probably for like 3 or 4 of them, not all of them, but I was just like, okay, I don't need to keep doing 50. And then I tried to move it in for the puts from 60 to 30, and that didn't work either. So I mean, this seems like the sweet spot at 60-day expiration, and then selling one below the current close and then buying one above the lower standard deviation. And you're looking for 25%. And the other good part is we don't have to put a stop on this. I mean, if you're getting 40% reward, then you're only risking 60. So putting stops in, you can try and do it manually like you guys do off the screen, and the study screen, you can obviously still test them, but the way the market has been working for quite a while, you have this kind of big drops real quick and then it bounces back, so it's just like it stops people out. So it just makes sense not to try and incorporate those, at least with end-of-day data. Maybe when we get to 20-minute type data, we can do a better analysis, but I'm only getting one snapshot at the end of the day, so I think this would a great starting point. So any other?
Yeah, I've always found that stops on bull puts, it's almost like there's somebody devious out there who goes out of their way to hit my stop on purpose, right? So I generally don't use them because they always seem to trigger it. Then the stock bounces back up and ends up being a profitable trade.
Right. No, I don't know if there's an evil force out there against you, Sudhir,
Yeah.
but yeah, I mean, that's just how the market's been functioning. And I think the best way to control your risk is by how much you put in per trade, each trade. Obviously these are systematic strategies that you want to keep playing, and, you control your risk by, how much you put in per trade, and not try and, tweak little, oh, I don't want to see a 50% drop or something like that. It's just, you're just adding in way, a lot more variables. And every time I test them to try and put in stops like that, it just, dramatically decreases, the overall, ROR per day type, metrics and, things like that. So,
Yeah, I agree.
all
Josh,
right.
Josh, is there a reason why 60 days versus 30? Because I've normally been doing 30 days, and I think Gene as well
Yeah.
likes the shorter period of time. Is there a benefit in risk to reward, or something else in mind to have 60 days?
Well, the few tests I ran, for old studies on, where I moved it into 30 days, all the metrics went lower. So your profit, your win percentage, I think you just overall, it didn't work as well. Now, I'm not saying that's going to be for every trade, but as a whole, they weren't, working as well. So, diving into, I can't talk off the top of my head on all this, specific analysis, that to like go through, and, this was a while ago I created all this stuff. So I don't, as far as specifics, I can't talk off the top of my head on why, but, I just kind of follow the numbers where they tell me to go.
Okay.
But, obviously, it wasn't like a dramatic, but it was noticeable. So I was just like, all right, I tried 30 on like 3 or 4 of them. I'm like, nope, let's go back to 60. So, and it really didn't affect, your days, anything like that. It wasn't like, oh, it's a lot shorter. I think your average risk you're probably not going to be getting as much. If you go shorter in, as far as your reward percentage, because you got a lot more decay out at 60 than 30, right?
True. But aren't you gaining money by having that decay, since it's a bull put versus a bull call? You're not.
No, I'm saying you'll get more premium on the further out one than you will in the shorter one.
Oh, okay.
And you can test it, and, you can do like analysis like this. Okay, like, you want to create, I would say, if you're questioning it, I just go through on like state 1 transitions, and I add in a few. You could do one bull put at, 30 and one at 60, and, kind of track them like that, and, you can report back. But, I just, I've been following the back testing numbers. So. Okay, anyone else got comments, questions, thumbs up?
What would that strategy be in the settings, like if we set it up?
Yeah, I can show you. So let's go to our general settings. Option strategy. I want to change this anyway. So bull put, right? So this is the old one, lower standard deviation above 1, strikes from like 2. So basically this would be strikes from close below 1. And then we got lower above 1. So you're selling 1 strike below the current close, and then you're buying the next strike above the lower standard deviation, right? And then you got 25 and 100. Does that make sense?
Yes.
Okay. Now it's automatic for me. So if you go in here and you select the different strategies, when you pull them up in those screeners, it'll every single time when I click bullput, it'll pull this up now. It's nice. So, okay.
Josh, this is Shawn. Shawn, real quick. You probably said it too, and I wasn't listening, but for the new one that you have here, did you have a minimum credit that you want to receive of the spread? I know for that one that you did 40%. Did you do one for this one or no?
No, I tested 40%, but it did. There wasn't a huge difference. I think.
Right.
Yeah, obviously, a lot more rejected trades. So things went up slightly.
Yeah.
It's a little better. It's one way that us internally we can control the number of trades. Obviously, you want the higher the minimum reward, the better. So if it's 50%, and it's 10 wide, you're getting $5, right?
Right.
So obviously, the better reward percentage, the better for you. I would. I didn't test like a minimum, but most of them were above at least 30%. I'd say like 90-something% of them were at least like above 30% reward, somewhere in that range, between 30 and or more. So.
Right. Yeah, and the reason I asked is just because that's kind of what Sudhir mentioned, right? Wanting at least the 20%. So have you used that before, Sudhir, in the actual extended back test where you can tell it you want a minimum reward based on the credit you receive, or did anybody not know that was there or knew that was there?
I haven't used it.
Okay.
It's just something I do manually.
Yeah, you can kind of see the trade and figure it out. Yeah, it's something that is in there. So when Josh come up with this idea, I ran some of them on Amazon and some different companies like that, different symbols. And I would use that, I would use at least I wanted 20%, and then I worked it up like Josh did, kind of to 40%, just to see if it, added value or not to the particular trade. Because, I do the same thing you do. I'm going to show one in a second, and I'll talk about it then. But, if it doesn't meet my minimum, personal requirement typically, then I won't do it as per the study. I might try to adjust the trade a little bit so it matches the credit that I'm expecting for the risk that I'm planning to take on.
What was the criteria to make that trade?
That was Keltner. That one. I'll just show you. I'm just going to show you real quick before Shawn goes where the min reward is. I guess we're clogging the system. So it's over here on the top. We probably never mess up here, but that's your min reward. So I can change it to whatever I want. Single one number at a time. So that's it. So
yeah. All right.
All right. You ready, Shawn?
I am. Yep.
All right. You got the floor.
All right. Let's see how I can. Whole thing has changed on us for Zoom, so I'm going to share my screen, I think. All right. So yeah, that was what I wanted to mention. That one, Josh showed that. I wanted to show you guys, what Sudhir was talking about, and like I said, I kind of do a similar analysis myself. 2 days ago or yesterday on the 9th, I think Match.com came in as one of the studies that had dropped significantly over the past couple of days. So if I go into my studies and high probability, this 10% pullback bull put, we can see, I think it comes up as Match.com. So we can see Match.com come up. It's 100% win over two occurrences. If you open up the trade, you can actually see, markets at 141. We're selling a 115 put, buying a 105 put. Now we can see the credit essentially when the trade come out was around 174 for a 10 wide spread. So we're collecting 174 and our actual risk is 826. So, if you're looking at it as like $200 versus 1,000, that doesn't really meet that requirement of the 20%. or right there at it. So, you know, I will use that min reward percentage like Josh shows, and maybe back test something a little bit in more detail to say, hey, I at least want to get 20% or 40% or whatever that sweet spot is for the trade. Like Josh mentioned, each trade is going to be a little bit different. You know, so to run the analysis using no min reward and then kind of start working your way up might be the way that you would want to do it, just to test it and see the numbers in full. But, you know, that's kind of what we were talking about here. So this is a trade that I might go in and try to adjust a little bit to see, you know, what happens if I sell, you know, maybe a 130 and a 120 put spread, and then I'll back test that and see what the results are. And does it still match a high probability trade? You know, is my win percent, you know, still above 75? Do I get, you know, the same number of occurrences? You know, just different things like that I'll kind of run through if that trade setup doesn't match the trade setup that I want to do that particular study. So
Is there a reason why it's
you know,
4 months out?
this is
Expiration?
the one. This is the original one. So this is the original 60 days is the minimum. So match must not have any other options that are available for you know, where you have August, September. So they must not have any October or November options for match. I think I can go into the option chain. Let's see if it pulls it up. We'll see which options are available. So we have match, and then we can see they have September, but September is less than 30 days or roughly 30 days out, right? Like 30 something odd days out. And then from September, it goes all the way to December. So those are going to be the next available options that have 60 days, you know, at least 60 days of expiration on them. Does that make sense? Because that uses 60. So yeah, if there's no October, you know, or no, you know, November, then it's going to pull the next one available, which in this case is December. So, and that's another, you know, that's another thing to take into account, right? When you pull up this December option, you know, you're looking at a minimum of 30 days or 60 days, excuse me, on the trade. But when we go all the way to December, we're talking 130 days. So that's another, you know, that's another criteria that you might want to look at, you know, based on what you see there, right? So you're looking at it and saying, man, why am I trading a December spread here that is so far out? And if there's no options available between there, you might be like, well, you know, I just don't want to, you know, to put my money in that type of trade for that long. It doesn't mean you're going to hold the trade that long, but, you know, you could look at a couple of different factors. You could look at the, you know, the total delta of the trade and see how that would react with the price movement of the stock. And that might give you some good ideas of, wow, if the stock moves $1, my trade's only going to move, you know, 10 cents or whatever. And that might not be, you know, something that you'd want to put your money in. So that's just another little checklist criteria that you would want to have
Shawn.
there before you put these trades on.
Shawn,
Yeah.
it's Jean.
Hey, Jean.
But okay, so there's a big spread between those months with options, and September, well, it's a little over 30 days. Would you not have even tried to back test it, do you think, to see if there was, I don't know, any way?
You can, yeah, definitely. No, I mean you
what
know,
if you
when
did?
yeah.
And
Yeah, I mean, you could definitely back test it using the 39 days instead of the 60. You know, you could say, hey, let me see all the trades 30 days or more, right? And run the bull put strategy using 30 days and see how that works. You know, I would always suggest testing different criteria, you know, within the platform. You know, we've kind of provided those base rules, and really 60 days is kind of what we used as the base to try to spread that across, you know, our whole database of customers that use it. But, you know, Gene, you might want to say, well, 60 days is too much. And Russ might say 60 days is too much. I want 30. By all means, test the 30 days and see. You might find a better strategy. Now, that strategy for 30 days might work well on Match, but it might not work as well on Amazon or Google or whatever. But those are going to be something that you would want to individually test. You don't have to individually test each symbol. You could take that 30 days and apply it to all symbols that you want to test, you know, all 300 and some odd symbols in our liquid list. But, you know, it might work for one, but just because it worked for Match, don't assume that it's going to work for Tesla. Test the Tesla as well, and then use that number to make your basis on if you should do it or not. But yeah, by all means, you know, I look at these and I look at 39 days, or, you know, because imagine if this, instead of being 39, it said 59. If it says 59, the back test is going to drop that one off. It's not going to see that as a valid trade because it's not 60 days or more. So 59 is pretty close, you know, so that might be a judgment call where you might be like, all right, well, let me test 50 days and see how that lines up, you know. In my mind, that one day wouldn't matter that much, but it might when you test it. I don't know. So,
Okay.
you know, and I see that. Yeah, I see that a lot. Not a lot, but I do see it where it says 55 days. I'm like, oh, okay. Do I really want to go out 130 days or do I want to go out 55 days, right? And that's just something you gotta kind of look at as well.
Would
Hey,
you also
Shawn,
look
Shawn.
at the volume?
Yeah, definitely. I mean, I
I
would be
mean, we're
looking
seeing
at,
we're seeing zeros on it, so
yeah. I mean, some of these you can see. I mean, we're talking about a bull put. You know, we're talking about what was it, 115 and 105. You know, this is the September options. So if we go to December, you know, we got a little bit more. 115's got 4, but the open interest is pretty high. You know, I'd be looking at my bid-ask spread. You know, my bid-ask spread on some of these is a little bit wide. I mean, you know, 40 cents is kind of wide when you're talking about $4, right? So that's definitely something that I'd be looking at. But similar to what Sudhir had mentioned, you know, it's great when you're working a spread, because when you're working a spread, I feel the bid-ask spread is there and it is what it is, but you can kind of calculate a pretty good price that you would want to sell that spread for and put the order there. And if they don't want to take it, you know, so be it. Just move on to the next one, right? Let them figure out if they want to take that trade or not. And if they don't want to buy it from you, then, you know, oh, well, I won't do match. I'll do the next one that comes out. But yeah, I would definitely look at that volume. I mean, open interest is pretty high, but volume's pretty crucial too. I mean, if there's 0 traded, you know, like on that September, I think there was 0, you know, I might be like, oh, okay, well, I don't know if I want to be that one guy that's trading it for that day. But, you know, you do have open interest of 44 or so.
Shawn?
Shawn,
Oh, sorry.
Yes, a couple of guys, go ahead. Whomever wants to go first.
hello.
Go ahead. Hey,
Um,
yeah, I hear you.
Shawn, when I look at the daily studies daily, and a lot of times we're looking at 2 events in 14 years. I feel like that's not a lot of data points, but I wonder if I'm being too critical.
You know, for me, I don't think so. You know, I feel like, you know, if it's 2, then I'm definitely somewhat like, you know, there's only 2 occurrences in the past. When did those 2 occurrences happen? You know, maybe one happened in 2018 and maybe one happened in 2010. I don't know about match, if match goes that far back, but, you know, it could be spread out that wide. And if it is, you know, what happened. You know, that's kind of a judgment call. I try to look for a little more occurrences than that, but, you know, I think I mentioned this before. You know, we went on a call, I think a couple of years ago, and they were talking, I think, about Apple. And I think I talked to you guys about that Apple momentum trade. And they're like, oh, you know, this Apple momentum trade is so great. It works like 97% of the time. And I was like, that's so awesome. That sounds like such a great trade. And then I back tested it, and it only had, I think, 3 or 4 occurrences over the past 15 years. So I was like, wow, you know, 97% or whatever it was is awesome. But you're right. When you look at it over only 3 trades, you're like, I don't know. Or I don't know if it was 3 because the numbers don't add up, but you know what I mean? It was I thought it was going to be like 200, and it was actually only a couple. And I was like, well, that's weird. But if it's something that's spread out, then maybe you could say, well, it doesn't happen that often, but when it does happen, it's pretty accurate, right? So you can take that, I think, one way or the other, right? But I don't disagree with you on if I see 2, it does kind of make me want to dig in a little bit deeper on it.
Hey, Shawn, it's Josh. Hey, yeah, I completely agree. I mean, if I see 2, you know, by itself with a back test, I'd like throw it in the garbage. But, you know, if I'm following us, because, you know, we've done this like a systematic test over, you know, over 300 symbols. And, you know, basically the strategy works well, you know, for, you know, almost all the symbols. So really at this point, you know, that total number wouldn't, you know, put too much into that. But, you know, if you believe in the study, I think that's really, you know, if you see one populate for Keltner pullback or whatever, you know, if you want to, you know, really, you know, I think you're putting your faith in that overall testing, you know, for the most part on everything. But, you know, that's just my opinion. You know, we require at least 2, but, you
Yeah,
would.
Josh, that's why I asked if I was being too critical,
Mhm.
because those two issues are kind of diametrically opposed. It's a 2 is a very low sample rate,
Right.
but if you really believe in the study, you could end up saying, well, gosh, it happened again. The third time is going to be great.
Yeah.
Right.
Yeah. Typically, it'll turn out like that, but not always. Yeah. I think it's
Right.
90%.
But one of the
time.
things to consider is, this is, I know you guys are working on a figure of merit and all that kind of stuff. One of the things to consider is how many total trades were recommended that day. You know, when there's 5 or 6 trades, or sometimes there's, 10 trades recommended on the alert, I will favor the ones with more occurrences. So if there's something, let's say there's a trade out there that is sitting at 80% but has 9 occurrences, versus a trade that's 100% but 2 occurrences, I'll favor the 80% win rate. You know what I'm saying? You're
Right.
absolutely right. If this is the only trade available, right?
Yeah.
Then you're right. The back test works, the system works for sure. But generally, you're looking at it among, you have half a dozen on the studies, maybe a couple on the alerts, then a few on the earnings plan. So you're trying to, decide which of all these trades to enter, right? It's not just the one trade.
Right.
You follow what I'm saying?
I agree with that. And if I sit here, if I see something like that, if I see 10 occurrences with an 80% win rate, I'll go in and drop the profit target to 15% to see if I can get the win rate up to 90. Then I'm really happy with what I'm looking at.
Right, right. So it's always, the Delphian system, to its credit, generates a lot of trades. So you have to kind of, unless of course you have unlimited buying power and unlimited time to manage the trades,
Right.
you have to kind of, weigh this, and the number of occurrences is something that I weigh when faced with choosing between trades.
This is Dave. I have a question for Shawn on match specifically, and then I had a couple of comments I wanted to make on just logic comments. I assume that because the matches it came up, it's considered a highly liquid stock. Is that a good assumption? Yes.
I don't know if I would say highly liquid, but
Okay.
fairly liquid.
I would almost question that, and then. Well, okay, specifically to match. I was listening to the TDA traders. They traded match one day on their daily show. I didn't, but I listened to their logic. And one thing I took note of is that is a company, it's a dating company, right? But they have like 50 different franchises, almost all of the ones that are dating companies that you can think of. And they acquire new ones all the time. So the Delphian model, or Delphian systems, if you will, strategies work when everything about the company stays static, if you will. But if a company does a lot of M&As, take Salesforce, for example, or even this quarter or this year, we have AMD and NVIDIA both acquiring huge other companies, right? So this is going to change their business model. So what you see over the past 20 reports is likely or could significantly be different because of a huge change in the business model or an M&A acquisition kind of thing. So you kind of had to take some of that into account when you're looking at whatever trades show up on the Delphian system. You look into them, you got to kind of apply a little bit of what kind of company is that really? And are they the same company now that they were 2 years ago or 5 years ago or 6 months ago? Because if you think they're not for any reason, then you have to think about some other things. Then maybe there's a different trade you want to make because, oh, this is a more traditional company that hasn't changed, and I'll stick with the you know, how it fell out in the strategy assessment, you know, filtering process. So that's one thing I just wanted to say is, and that was a unique company. I had no idea that Match had that many other brands, and they were talking about just having acquired like 2 of them. You know, same thing goes
Right.
to, same logic applies to some of these newer companies that are just building out. The second thing I wanted to say is, I think even though some of these things might be considered liquid, when I do a lot of counters and diagonals, right? So I'm looking at swing trading out there, probably maybe, I don't know, 2 weeks to 10 weeks or something like that. And whenever I see that there's no matching, I can't get a double one time frame that's exactly twice as the other. And I look and say, oh, they're missing monthlies like you were in Match here, or they're missing weeklies because they haven't shown up. There's weeklies all the time, but there's not a weekly out there in October yet, for example. We're already in August, right? Those tend to, maybe they're liquid, but they're wide markets, and which kind of corresponds to what we don't want, right? You don't want wide markets because then they're hard, you know, they're getting in and out is tougher. That's the bottom line there. And I found out every time I see, well, here's an interesting company to look at, and I go in and look at a trade like that, and I can't find, oh, it's missing something. It's not worth making the trade. Every
Right.
time I was like, well, I'll look onto something else because I'm either not getting enough money for credit for the long option that I want to buy. I'm sorry, I'm paying too much for that, or I'm not getting enough credit for the short one that I want to sell against it, which is usually the case. Is the debt for the short doesn't really, you know, it sounds like a good strategy and it works out and it fits all my, you know, setup criteria. Financially, it doesn't make sense. So I mean, when something is missing, when you're seeing an expiration that you think should be there and it's not, that's a warning sign, a red flag in my book almost every time. Just my observations and comments. Take it
Right.
for what it's worth.
Yeah, and I don't disagree. And I feel that if you're doing a trade and you're looking at Match and you're looking at this trade and you see the options are expiring in December, or you see the credit you get is not, you know, to your liking or whatever, if something looks amiss, you know, I'm always the proponent of, you know, don't do the trade, because typically those are the trades that I've lost money on in the past, or ones that I wasn't fully committed to. And if something seems amiss, just pass on it. You know, there's no reason to make yourself do a trade. I think like Sudhir just mentioned, you know, there's so many different trades that we're pushing out, you know, in the Delphian platform that have been tested, you know, that show really great results, that you don't have to take every trade. And if something doesn't look right, you know, don't trade it. If you don't want to go to December, which for me to do a trade like this on Match would be very hard for me to want to sell a put spread all the way to December. So like Gene had said, I might test that 39 days or 30 days and see if I can get a similar result, and just be prepared. You know, I want to know, you know, what I'm getting into before I get into it. And if I can't figure that out, then I just don't do the trade. No reason for me to kind of be unsure of what I'm doing. I have Delphian, and I'm using Delphian to make sure, you know, I'm prepared for, you know, all the outcomes and what's possible to happen. And that's what I'm using it for. So I don't disagree at all, Dave. You know, but I did want to mention though, you know, on Match, you know, really with these different strategies, you know, as we've talked about, kind of swing trading, you know, not really day trading, but swing trading, I'm really not, you know, in this particular instance here, me personally, Josh might disagree, I'm not really investing in Match. You know, I'm not investing in Match going, I am thinking Match is going to go higher, but only because of the fact that Match has met this particular criteria. It's dropped a certain percentage over the past, you know, couple days, and it's been in state 2 and it's met its target. So I'm not, you know, looking at what has Match acquired or what have they not acquired, or is it good or is it bad. I'm really just saying, hey, it's dropped a huge amount over a short period of time, and I'm really thinking that this stock could maybe bounce, you know, 3 or 4 or 5% to the upside. And if it does, you know, hopefully I'll get out of this trade. Now, you know, again, we're talking about December options, might be a little more difficult, but typically if I get a bit of a reversal back to the upside, that's what I'm trading. I'm not trading, you know, do I like Match and do I like the fact that they acquired, you know, whatever. I can't think of another company that with a good name, so sorry. But, you know, that's really what we're looking at here, in my opinion. So.
Hey, Sean, yeah,
Um,
I think it's like a good secondary analysis, like, okay, like when Sudhir's like, okay, there's 10 trades, like, okay, what, maybe there, you're looking at, total trades, maybe like strong names that you've done, are doing well overall and growth stocks or something like that. I mean, that's kind of
Right.
like the second layer I think people can do on their own. Yeah.
Sure. Yeah, that's fair. And there's a lot of different metrics, that you can use to run certain analysis, and taking those stocks and putting them in a stock list and running a different screener on those wouldn't be a bad idea. I mean, you could see a bunch of different analysis within there to find, some secondary confirmations for you. So, yeah. So cool. I don't want to go too far past 2 o'clock, but there were a couple of quick things that I did want to show you guys. Josh had mentioned, that bid-ask spread earlier. I think we've talked about it before. If you go into your custom screener, once it pulls up, we can always look down here at option filters, and we can look at option spread. And so the option spread is essentially what Josh and Bob were talking about earlier, taking a difference between the bid and the ask price and then divided by the price. And that's where you're going to get these numbers here. And you can read the different, descriptor here on base what it's looking at. So typically they're talking about, you're looking at a 0 to 1% for them to be fairly liquid, if you will, based on the bid ask. So if you did something like, 0.10 to 0.5%, and we're looking at the liquid options list, if I hit find stocks, my list might be, I would say sub 100 or so, if even that, maybe sub like 50. I don't even know. But you can do this to run on, any symbols, any stock list that you have. So if you have a stock list of 50 stocks and you want to look to see, what the bid-ask spread is, it'll show you and it ranks it here. So using this new liquid options list and running this option spread from 0.1% to 0.5%, we can see that there's only 18 symbols that come up, Apple being the top one. So Apple, Walt Disney, going all the way down below. And we can see the different spread percentages here. I can, sort it, in reverse order if I wanted to do that. But, a fairly tight list. So again, it's taking the difference between the option price and then dividing it by the price. You can always do it, based on, we have the ETF.
Sean, wait just a minute. How do you make that list a stock list?
Yep, no worries. Well, this is just one of the stock lists I have set up, I think, based on the liquid list that Josh had provided, the new liquid option list.
I understand that. How do you make the new shorter list a new stock list?
Yep, sure. So go to custom. So you're going to go into your stocks and then go into screener. And then you can go into custom. And then under custom, you'll have this list over here on the right-hand side. You can select option filters and then option spread.
So how do I save it as a new stock list?
Oh, this one as a new stock list. So if you wanted these 18 as a stock list, you could click on add. Yep. Add to stock list. Now, I typically never will override a stock list, but I will add a new stock list, and I could say new stock list. I'll give it a name, and we did the spread as maybe like option spread. Let's say, 0.1% to 0.5%. And sometimes in my description here, I'll even put today's date, just so I know that's the date that now when you go in there and look at your stock list, it'll show you the creation date, but I put that in there just for my personal as well. And if you hit save, it's going to save it. And if you go down to your organizer and go into stock list, and then always under the user define, because you are the user, you're defining these stock lists for yourself. You can see that it basically has it right here, option spread 0.1 to 0.5%. If I click on it, it actually should show me the 18 symbols there that are used to create the list. So we have the 18 symbols here, so we can see 18 down below.
That's really nice. Thank you.
No worries. Yeah, and then anywhere. So if I wanted to go back into my screener, and let's say, okay, I didn't look to see what symbols are exactly there, let's say, but let's say I go into my custom screener. You know, we've talked a bit about the grades, you know, the Delphian grades. So let's say I'm going to change my stock. This is the new list I just set up with 18 symbols. Now, let's say I want to look to see which one of those 18s have a Delphian grade, current Delphian grade in growth of an A of 90 or better. If I hit find stocks, 4 come up. So now all these 4 stocks have a Delphian grade A within that growth sector, better than a 90 score. That score is based on, you know, the stuff Ashok had set up. But we can see we got Amazon, Facebook, Google, Tesla, you know, and then you can just run, you know, further analysis on the 18 symbols. And now we have 4. You could say which one of these 4 maybe in state 1. So we could say, show me, you know, state model, current state, let's just say state 1, find stocks. So now I went from 18 symbols to 4, and now out of those 4, these 3 are currently in state 1. And so then I could obviously go a little bit further and say which one has hit their target, you know, profit target 1, or which one has not, and so on and so forth. So once you create your own stock list, I mean, there's just so many different things you can use this screener for to check it out. I know I kind of went off, you know, note a little bit, but the option filter, option spread, I mean, this is pretty huge. You know, we use this in our, you know, liquid options list, but remember that if a stock price changes, or if the bid-ask price changes on the options for whatever reason, you know, this percentage will change. So a stock that might be, you know, below 0.5% based on this option spread percentage today might not be below 0.5% tomorrow, because a couple of factors have changed within the pricing of the options and the price of the stock as well. So it could change a little bit. And if it's, you know, if it's 0.5 today and it's 0.51 tomorrow, well, it might not be on my list today because of that 0.01% that it changed. So, you know, always take that into account. And that goes back to that match. You know, that match could have been liquid, you know, a couple days ago, but maybe today it just scooted outside. So maybe it's not as liquid, you know, based on volume or open interest or whatever. So, you know, those lists, you know, those lists are not, the stock lists that we set up are not dynamic. They are static, but the criteria that make up those stock lists are dynamic. So that can be changing a little bit. I don't know if that makes sense or not. So I wanted to show that. Cool features. Use this option spread. It's really cool. I mean, you can use that on your ETFs, you know, IWM, SPY, things like that. And you can see, you know, those are probably going to have your best, you know, bid offer spreads, because it's like $1 at $1.01, really, really tight, no difference between the two. So you can do those. I did want to show you real quick. I'm over just a little bit in time, so I apologize, but I did want to show you guys 2 trades, Amazon and Moderna. Amazon, we did not have on there as a vol crush trade because it didn't meet all of the requirements for this new list that we'd come out with. But we can see if I add my earnings on here, my earnings dates, we can see they had earnings the week before last right here. I think the expected move was like $150, so right around $34.50, which would have been here. You can see Amazon dropped well below that and moved outside of that expected move range. So good thing we didn't have that as part of our list, because that would have been a max loss on that trade. And then, you know, Moderna is another one that had come out last week. We can talk about this a little more in detail next week. You know, Sudhir and I were watching some other, am I not typing it in right? It's MNRA, right?
MD.
Is it MD?
Yeah.
I thought it was, mRNA. Yeah, sorry. Sorry, brain malfunction. Brain malfunction there. I was like, we don't have it. I was like, I could have sworn we had it in here. So I wanted to show you guys this one too, because earnings had come out last week. You know, here's the bar up for earnings. The close was right around here. Stock the next day opened up and pretty much traded well within that range. You know, I think Sudhir made a little bit of money on it. I made a little bit of money on it based on the trading style. And Sudhir even tried out one of the double calendars. We'll get into that a little bit more next week if that's okay with Sudhir. But you know, there's some great trade designs out there that we can use for some of these trades. but we just need to test them. And then a quick side note as well. Joe and I were on a call yesterday, and they were talking about earnings, and it was really interesting to hear the different analysis based on, you know, stocks that have earnings coming out after the market close versus before market open, and the time that you have to react to those particular trades. So if a stock reports earnings after the market closes today, you know, everyone has time to kind of digest the earnings overnight until trading starts tomorrow. So the volatility might be a little bit different based on that earnings report. Whereas if you have earnings releasing tomorrow morning before the market opens, if the release is at 8:30 a.m. and the market opens at 9:30 a.m., not as much time for everyone to digest that information and then trade on it. So you might have a little more volatility coming out the next morning. And then also they did mention, you know, Berkshire Hathaway and Warren Buffett decided to, a while, I don't know how long time ago, but, you know, his earnings come out, he reports his earnings on Saturday. And the reason that he does that is because he wants less volatility to be there. He wants people to be able to read the report, digest the information, and still have a couple of days to trade it before market opens, you know, or, you know, time to digest it before market opens on Monday. So 3 bits of information that, you know, I heard that I thought was really interesting, and I'm really going to try to apply to some of these earnings trades that we have coming out. You know, we've talked about adding something like that as a screener so we could test to see if it matters, you know, BMO or AMC. It sounds like it does, but when I think about it, but I want to make sure I can put some analysis to it. So, you know, food for thought. If you guys think that stuff would matter based on the timing of the earnings, shoot me an email, let me know. I think it'd be cool to hear you guys, you know, ideas on that. But, you know, that's all I had. Again, sorry for taking too much of the time, but, you know, I thought we had a great conversation, everybody. So I appreciate you guys taking the time. So that's it, Josh. Thanks, everyone.
All right, thank you, Shawn. And, you know, that's all we had for this week. Thanks to everyone for attending and the great participation. So thank you.
Thanks,
Thank
guys.
you. Good meeting.
Thanks,
Thank you.
guys.
Very nice.